Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. During the second segment here, we're going to continue talking about some of the economic data that's coming out and if you should worry about it, if it has anything to do with your portfolio. If you missed the first segment, you can head on over to the website, which is www.dlblain.com, and there you'll find archived copies of the show posted. Now, at the end of this, I'm going to go through some of this data, but at the end, I'm sort of going to give you the punchline or whatever, is that a lot of this data in the short term, it's just noise. And I think as we look at the numbers, we see, month-to-month changes, and people try to overanalyze what's going on. You have people attribute, for example, someone was saying the housing-related goods, the poor sales of housing-related goods in the past month were due to wet weather. And so you have things like the weather affecting sales. And so we typically don't put too much stock, especially in these month-to-month figures or even year-over-year. What I want you to take away from this is that these retail sales growth has been very volatile. You have tax increases, you have the spending cuts, sequestration, and we haven't seen this collapse of the economy that some people were predicting from sequestration, but we do see some volatility. As I mentioned in the first segment, still some people are waiting around for the collapse of the economy from the financial crisis in 2008, and so you still have some hesitancy to spend. We see housing making a nice rebound. I was reading an article yesterday, I think it was in Houston, from the Wall Street Journal. There's no place for builders to build. The price of housing in Houston is spiking because the demand has come back significantly, but the builders have no place to build because the banks are still, quote, fighting the last war, meaning they're still looking at developers based on pre-recession data, and they took some hits, granted, and so they're not loaning money for land development, and so these builders have no place to build, and it's driving up the cost of housing. We see this happening in different places. I was visiting my parents who live in Northern Virginia outside Washington, D.C. over the weekend, and I mean, the place up there is booming again. People are selling houses, they're getting multiple offers on the same day for houses. My brother, who lives in Chicago in downtown, he and his wife were trying to buy a place, and they were having a very difficult time getting an offer in on a place before it sold. Their realtor finally called them and said there was something that she thought he might like, and my brother said, well, okay, we'll go look at it this weekend. She said, no, if you want any chance at all of getting this house, you need to come now. And they did, and anyway, they ended up getting a house. But the point is that we see this resurgence of housing in different places. Other places, we see that housing is still not really recovered very much. Things are still slow, maybe a little bit of a pickup, but things are still slow. We see unemployment in different places still very high. Other places we see it has picked back up very rapidly, and the numbers have dropped significantly. Not just, we see at the national level the numbers dropping. A lot of that, frankly, is people leaving the labor market. But there are, particularly your more highly educated people, the unemployment is definitely dropping. Okay, so that's retail sales. We've seen a lot of volatility in retail sales on a month-to-month basis. But in general, obviously, since the recession in 2008, things have gotten much, much better. Inflation, it still remains in check. I mean, this is one thing. We don't try to predict things, trying to predict things, as Yogi Berra said, prediction, especially about the future, is very hard. I think I got that right. But anyway, so we don't try to predict the future, but if you asked me 4 or 5 years ago if I thought inflation was going to be much higher today than it is, I would have said yes, most definitely. But yet inflation continues to be in check. The CPI rose a modest 0.2% in July, compared with 0.5% increase in June. We see increases in gas, housing, clothing, and food were the primary drivers of the uptick. And one of the things that the CPI energy costs and food costs, which are, people don't buy a house every day. People don't, buy a computer every day, these type of things. But it's that food and energy costs that people notice the most. And so when gas prices go up, people think inflation is really surging. We see that the core CPI, which excludes food and energy, also increased 0.2% in July. Wholesale prices were flat in July. It's something that we look at. The consumer prices can be a little bit more volatile. Another statistic to look at is the PPI, the Producer Price Index. We saw those were flat, down from a 0.8% increase in June. And so we see that there's still some volatility in the prices, but not this wholesale runaway inflation that a lot of people thought was going to take place. The printing of the money and all the stimulus and the flooding of money has just not produced that inflation. As I've talked about before on the show several times, a lot of people equate rising prices to inflation, and it's a subtle difference, but an important difference. And inflation is a monetary problem, not necessarily a price problem. And well, we're coming up on our second break. I'll probably hold off in getting into detail on that, but it's something that I do want to explain a little bit more is inflation versus prices going up. They're really two different things. So for All Things Money, I'm your host, David Blain. We'll be right back for our final segment in just a few minutes.